The following is a presentation of TFNN. It is now time for Trade What You See with your host, Larry Pesavento. Now, Larry Pesavento.
Okay, good afternoon, folks. I started the Tiger TV show today with a chart on BBC, which is the ETF for commodities, and we've been talking about the bearish nature of these for quite some time, and we've had another, big move down. We'll bring the price of copper and talk about copper extensively here a little bit later, but the first thing that I wanted to do was just to alert you that you have these things happening in the commodity markets. I mean, it's nothing new. They've been coming down for weeks and weeks, and they're starting to accelerate. Gold actually is making a 61% retracement off of last week's low. We've been waiting for that around that $1,570 per ounce level. And if that, frankly, doesn't hold, then you're going to be taking out 1555, and then shortly thereafter 1527, and then gold is going to probably start to accelerate to the downside. Silver has strong support at 28, but let's get to the futures markets. The next chart that I wanted to put in, I think, is very important. It's a 60-minute chart going back several weeks, and it shows the Dow Jones Industrial Average making what is known as a T6 symmetrical triangle, as outlined in Gartley's book, Profits in the Stock Market. It's also known as a broadening triangle pattern. It's also was called a reverse point wave by Wells Wilder. He sold this pattern in, I believe, 1980 or 79. No, it was in the early 80s. He sold this pattern for $2,500. That's exactly the same pattern. He took it right out of the book. And basically what it is that, wave 2 exceeds the low before wave 1, and then wave 3 exceeds the high of wave 1, and wave 4 exceeds the low of wave 2, and then the final push-up of wave 5 exceeds the high of wave 3. That makes it a 3-drive pattern. And the Dow Jones has had a big break of 150 points, almost 200 points. Coming into Friday, and then it rallied very strongly right up to the exact 786 retracement at 14,100. This was the only index that made new highs last week. None of the others, came in even very close. So this is a very bearish pattern. If it fails, the Dow's going to go above 14,200, and we'll have to, reevaluate, what the market's going to do if it does that. But right now, that pattern is certainly in force, and it is acting like it really wants to, hold up, relatively well. Now, I just mentioned the gold market because we are at such a very critical level here as we speak, and I will put that short-term chart in going back over the last 3 days. It's a 5-minute gold chart. And you can see we have a lot of support coming in at the 1570 level. It might not hold, but that's where the support is coming in. You have 2 of the ABCD patterns forming there on the 5-minute chart. But if we go, this is the beauty of the gold market, is it follows these numbers, incredibly well, because last night, Sunday, we made a perfect 786 of the high that we made on Friday. So it was just really, they follow the numbers just really nicely, so you don't have to risk an arm and a leg. Below 1566 here, about $5 from where we are now, you would certainly, this would be wrong, but right now it's holding up. The reason why I'm spending so much time, this is, it's my commodity show, I guess, but the main, it's my regular show, but the reason why I'm spending so much time on the commodities are because, this economy runs on commodities. It's a market of stocks in a stock market, but, they make their products by, buying things like copper and gold and wheat and corn, to make other products that are for sale. And if these products are going down in price, that's not a very good sign, for the economy, folks. I I hope you realize that. All you have to do is to go back and look at October of 2007, and we'll do that after the break. And when Mr. Bernanke came on, and he was on one of his fall conferences, he said he could see no reason for any problem at all in the stock market. Everything looked fine. He said there was plenty of liquidity around, and there was really no problem. And that was October of 2007. A year later, he was on a bed of coals in Washington because of the problems that they had. But, of course, they sweep it under the bed. And, that's 6 of one, half dozen of the other. But, that's why I look at the charts, and I'm just telling you that this is a very, very dangerous time to be in the stock market from the long side. I know I've been preaching this for, several weeks now, and the market really hasn't gone anywhere, the overall market, New York Stock Exchange index, but, the rest of them have started to turn over. Now, I wanted to spend just a second here or two, looking at the copper market because, we talked about this rising wedge pattern that we had last June, and then the market broke down, very, very badly in copper, and we had the same rising wedge pattern that occurred just a few weeks ago when we were talking about it when it was up at $3.75 per pound. It's now dropped 20 cents per pound. That's $5,000 a contract. And now, it left a gap today. Whether it's going to fill that gap, remains to be seen. But it certainly, looks like it's got $3 a pound as a minimum as a price objective on this. And so that's another factor that tells you that, these things are not nearly as bullish as they're trying, to tell us that they are in the stock market. And that's the main thing, that I think we have to, pay attention to. Another one that I think is important that Basil mentioned on his show is the New York Stock Exchange Index going back over the last few weeks. As we were making that broadening top in the Dow Jones that I just posted, we were making lower tops in the New York Stock Exchange Index. Now, that's the true index. The Dow Jones is a price-weighted index. That means that the price of IBM is heavily weighted versus the price of Microsoft. Even though there's only 30 stocks, the high-priced ones can make the index, go higher because it's price-weighted. The Dow Jones family has not done a very good job of marketing themselves. In 1981, the Chicago Mercantile Exchange wanted to do a Dow Jones futures contract, and the Dow Jones family laughed them out of the building, wouldn't even take a meeting, as I understand. And so Leo Melamed and his group went over to the Standard & Poor's people, and we had the Standard & Poor's 500. Shortly after that, we had the NASDAQ, and then about 10 years later, I think it was around 10 years, the Dow Jones became a future at the Chicago Board of Trade, but it didn't catch on very much for many, many years. So, these are the politics that I remember, going through, some of the things that occurred. So we've got quite a bit of divergence that is happening, at that particular one. But there's one particular pattern that I really think that is that's really important, and that is the NASDAQ pattern on the daily charts. And if you'll take a look at that, you'll see that we've completed a beautiful head and shoulders pattern going back over a year. The end of March of last year, we made a top. That was a shoulder, and then in September we made the head, and then we made this last shoulder, back in February. And that is a perfectly symmetrical pattern because the 1.27 to the upside was perfect, and the 786 expansion, which was also a Gartley pattern, was also perfect. It might not work, but this is a perfect textbook head and shoulders pattern, and it gives the price objective about 30% lower than where we're trading right now. Whether that's going to happen or not, remains to be seen. But this is, what we're looking at with the NASDAQ. It certainly has been the weaker of the indices, and a lot of that is due, to the price of Apple, and we're very, very close to the price objective that we were within about 5% now of what we've been looking at with the price of Apple. And let me get this chart up so that we can see it. We're going to do the daily first on the Apple because we have had several requests for this. But the ABCD measures down to this 395 level, and we're trading in the 420s now, so it's very, very close. And this stock, if you remember back in September, was getting all kinds of free advertising. Everybody was standing in line, and things changed, And if you weren't watching the price charts, you weren't aware that something was going wrong. They don't tell you when things are going wrong until they're way, way down in price, and then they tell you that, things are not, so good. Now, what we're going to do is we're going to take a look at Apple going back to the low that we made in 2009, and that price objective that we're looking at here, 395, is not only the ABCDs that we saw on the daily chart, it's also the 786 retracement coming off of the low from July of 2011, and it's an exact 50% retracement of the low from 2009. So we have a whole lot of things in Apple coming in at this below $400 an ounce. Now, believe me, I don't think for a minute that it's going to hit exactly 394, 395, and then turn. It's probably going to get very active around that point. But when it gets there, that's when we really want to start to look at a 450 call, going out to maybe June to get a 450 call, because if I'm totally wrong in the stock market here and we're not going to turn down, eventually some people are going to look at Apple and say, hey, this stock has corrected, about 45%. Maybe it's time we take a look at it. They do have some pretty good products. And technically it's in an uptrend from, if you go back from 4 years ago. So if you want to look at something, when it gets to that price, take a look at Apple. Once it gets below 400, I imagine it's going to be some type of a magical, number, and Wall Street will start tooting their horn and saying, here goes our next WorldCom, and there goes our next Enron. They'll always have stories like that because they've got to be the exact opposite of how bullish they were, at the top. Because if you remember, there people were standing in line for $100 just to buy one of those iProducts. I don't remember whether it was an iPad or an iPhone, but that's how those things are supposed to go. If you ever want to read about why this occurs, there's a book that was written in the early 1900s called The Popular Illusion and the Madness of Crowds by Donald Mackey, and that really explains many of the things it explains all of the things that happened in the past with the South Sea Island bubble, the tulip bulb mania, the stock market bubble of 1929, of 2000, the real estate land bubble in Florida, and things like that. So, we'll see if that's going to be the case. Anyway, we will look at somebody saying, take a little break here, 877-927-6648.
Daryl Martin coined the phrase diagnostic trading, and we're happy to announce that his diagnostic box spread analyzer has finally been released. The Diagnostic Box Spread Analyzer helps you easily identify the best box spreads on Nadex in seconds, plus you receive access to the diagnostic deviation levels, as well as step-by-step training videos teaching you how to trade Nadex spreads so you can quickly master the mechanics of this simple yet powerful trading instrument. By pulling live data from the Nadex exchange, the Diagnostic Box Spread Analyzer does all the math for you, calculating risk, reward potential, distance to break even for both outright spreads and spreads used to hedge the underlying market. Visit the front page of TFNN.com today to get your 2-week free trial to Daryl Martin's Diagnostic Box Spread Analyzer and gain access to the valuable information it can provide when trading the Nadex box spreads. You take a hands-on approach to managing your investment strategy. You're always looking for the next trading opportunity to magnify your perspective. Direction Shares connects sophisticated traders with a powerful array of ETFs from a wide range of asset classes. The markets may go up and down, and you want tools for both sides of the trade. Discover how we can help at DirectionShares.com today. An investor should consider the investment objectives, risks, charges, and expenses of the Direction Shares carefully before investing. The prospectus and summary prospectus contain this and other information about Direction Shares. To obtain a prospectus or summary prospectus, please contact Direction Shares at 800-851-0511. The prospectus or summary prospectus should be read carefully before investing. An investment in the funds is subject to risk, including the possible loss of principal. The funds are designed to be utilized only by sophisticated investors such as traders and active investors employing dynamic strategies. Investors in the fund should understand the consequences of seeking daily investment results, understand the risk of shorting, and intend to actively monitor and manage their investments. Distributor, Foreside Fund Services, LLC. McEwen Mining is a high-growth, mid-tier producer in the Americas with a market capitalization of $1 billion. Experienced mining executive Rob McEwen, as chairman, CEO, and president, owns 25% of the outstanding shares of McEwen Mining and has put in place an ambitious business plan with the goal of qualifying for inclusion in the S&P 500 by 2015. With $70 million in cash and liquid assets as of the end of 2012 and completely debt-free, McEwen Mining is poised for growth. Production in 2013 is forecasted to grow at 24%, reaching 130,000 gold equivalent ounces, and over the next 3 years, McEwen Mining projects that their production will increase to 290,000 gold equivalent ounces, almost a threefold increase from last year's totals. If you'd like to find out more about McEwen Mining, click on their banner on the front page of TFNN.com or check them out on the NYSE or TSX under the symbol MUX.
What type of investor are you? Conservative, moderate, or aggressive? No matter your investor personality, your overall portfolio should reflect your financial goals, time horizon, and your risk tolerance. Help ensure your portfolio is appropriately invested with an asset allocation plan from Morgan Stanley Wealth Management. Simply picking the right stocks is not enough. Research has shown that choosing the right proportions of stocks, bonds, and cash is essential to the success of your long-term investments. Morgan Stanley believes a carefully selected portfolio can lower volatility and increase investment return potential. Find out about what an asset allocation and a Morgan Stanley Wealth Management financial advisor can do for you. Call Angela O'Brien, First Vice President and Financial Planner of the Clearwater, Florida branch at 727-441-6108 today to discuss your personal financial needs. Asset allocation does not assure a profit or protect against loss in declining financial markets. Investments and services are offered through Morgan Stanley Wealth Management, LLC. Member SIPC.
This segment is brought to you by Great Panther Silver. For more information, just click the Great Panther Silver banner on the front page of TFNN.com.
Okay, folks, we're back, and I want to expand on the copper because if you'll take a look at what's happened over the last couple of years, you can see since late January of 2012, copper has been in a consolidation pattern with lower tops and higher bottoms. So it's a big triangle. We're below that, getting really close to going below that pattern right now. But it just shows you the huge divergence that's happened over the last 6 months with copper, going to the downside and stocks, going massively up to the upside. And, they had a 20% run, so that would certainly, qualify, that particular chart as a big divergence. Now, I did have some information from Miller Tabak. Jonathan Krinsky put a chart up of copper going back well over 8 years, and it shows the price of copper versus the S&P, and it also shows where we are right now is one of the worst divergences that we've ever had. If you'll notice, in the time of 2006, 2007, copper was also making a divergence at that time, and we had a big move down. So we have to pay attention to this with these patterns forming the way they are, because it's a very very dangerous time to be to be in the stock market, in my opinion, for a lot of different reasons. Now, there's another chart that I'm going to bring up that someone sent me. It shows the bullish consensus of where we are since 1996, and I will put that up here. Let me try to make it just a little bit bigger. Yeah, I'll make it slightly bigger. Okay, and you'll be able to see that we're at the extreme of bullishness in the stock market, which is not another good thing for being in a situation where you want to be too bullish, especially if you have your money in your 401ks and things like that. Someone asked me the question, how confident do I feel that Apple's going to make the 395 level? I don't know, but I'm a lot more confident now than I was at 480, 580, or 680. I mean, we're only $20-some, $25 away now. So you could, if the market weakens up, Apple has been a far weaker than market stock, and so you can imagine if the market weakens up, what could happen to Apple? I mean, it could really come unglued. You don't know. These are just patterns. They're nothing etched in steel. They're just numbers, that are there. First of all, you have the Fibonacci numbers to work with that bring everything together at 394, and then you have the ABCD patterns that are there. And so these are the things that we look at. That's what we're doing. We're not fundamentalists, folks. I do not know anything about fundamentals. I don't know what I haven't seen an earnings report in well over 40 years. And so that's the bottom line. I've got a second here. I want to tell you a sad story. Every time I go up to see my friend Mark Douglas up in Scottsdale, we drive past Portland Cement. It's a big plant here in Tucson, and my doctor was a member of the Portland Cement family, and that was taken out. Taken out. It was bought by Enron sometime in the 2004, 2005. I don't remember. And, of course, he had Enron stock, and he was very rich, and he was very happy. And when the stock started to go down, he asked me what to do, and it went from 95 to 60, and I said, you ought to get out of it. I said, you're still way ahead, you still got your investment, and he wrote it all the way to zero, and wouldn't get out of it, and it basically destroyed his life. He couldn't practice medicine anymore because he was so upset, and I don't know what happened to him. He moved away. Whether he moved back to Seattle or Portland or not, I'm not sure, but when I see that plant, every time I go by, I remember that, technician is not going to have that problem because, there's some point where it crosses the 50-day and the 100-day or the 200-day moving average or last month's low or last week's low. There's got to be a point somewhere where you say, this is not right. Like if the Dow gets to 14,200, this pattern that I'm looking at is bogus. It's just not going to work. But, there's nothing personal. It's just one of those things that makes it, makes it fun to be a technician because you don't have to worry about what's going to happen next in some of these things.
Just recently, on December 28th, Market Insight subscribers were advised to go long the QQQ, the NASDAQ 100 ETF, on December 28th at $63.91, and only 2 trading days later, after a huge jump in the markets, Market Insight subscribers were advised to sell the QQQ at $66.64 for a $2.73 or 4.27% profit to start off 2013. At the same time, Tom O'Brien had advised his clients looking for a more leveraged trade that they could have initiated a position in the QLD, the ProShares Ultra QQQ ETF, and over the same 2 trading days, Market Insight subscribers were able to lock in a $4.48 profit or an 8.47% gain in just 1 trade. Get your 2-week free trial to Market Insights today by visiting the front page of TFNN.com. Cancel at any time during your free trial and pay nothing. Don't miss out on the next great trading opportunity in 2013. Act today. Has the current market volatility continued to stop you out of trades when the market spikes against you? Now is the perfect time to open up an account with Nadex. Nadex, the North American Derivatives Exchange, is a brand new, completely regulated Chicago-based exchange, and unlike most other exchanges, Nadex allows you to trade directly through them with direct market access when using their completely free trading platform, which also features real-time charts and full customization capability. One of the advantages of trading with Nadex in volatile markets is that your risk is always capped and you have the ability of keeping your trades open even when the market spikes against you. Nadex is completely brand new with a line of unique trading products that are unavailable anywhere else. See how it works at nadex.com. That's Nadex.com. Or click on the Nadex banner on the front page of TFNN.com. Futures and options trading involves risk and may not be appropriate for all investors.
Recently, Basil Chapman has had some outstanding trades in his newsletter, The Opening Call. Each morning by 9 a.m., Basil uploads his newsletter to the TFNN servers so that his subscribers can access his expert trading advice. Basil gives his take on the direction of key indices and updates any active trades that his subscribers are currently in. Just recently, Basil's subscribers closed out a short position in Chipotle Mexican Grill, CMG, for more than an $86 profit per share, over a 20% gain in just one position. If you'd like to try out Basil Chapman's newsletter, The Opening Call, then visit the front page at TFNN.com and click Trading Newsletters. There you'll find Basil's newsletter, The Opening Call, where you can request a free sample copy. Also, don't miss Basil's program, The Tiger Technicians Hour, Monday through Friday, 11 a.m. Eastern, on TFNN.
Tom O'Brien's weekly newsletter, The Gold Report, has helped subscribers for over 10 years navigate the high-risk world of exploring and producing gold companies. And now's a great time to sign up for a free month-long trial to see the kind of insight that Tom delivers for his subscribers on a weekly basis. Every Monday, Tom O'Brien issues a quick update on the metal market, giving you his take on the HUI, XAU, GLD, dollar, bonds, and much more. Tom follows Monday's update with a full gold report, which is delivered to subscribers Tuesday afternoon with detailed coverage of 24 separate gold or metal stocks, as well as another 10 to 15 stocks that he lets you know are on his potential watch list. Get your month-long free trial to the Gold Report today by visiting the front page of TFNN.com. Don't spend another year navigating the metal markets on your own. Act early in 2013 and make the most of your gold and metal market investments.
This segment is brought to you by Crocodile Gold. For more information, just click the Crocodile Gold banner on the front page of TFNN.com.
Okay, we're back, folks, and I want to talk a little bit about gold and silver here because we're at such critical levels. On Thursday's show, we were talking about, silver making the, 786 retracement down here at the $2,700, $28 per barrel per ounce level. But if you take a good look at this silver chart going back for the past year, you'll notice that every time it hit the major retracements, the 50% retracement led to a $4 an ounce rise. We had a 61% retracement at $29.50 that had a $3 rise, and now, what we have now is we just made a 786 retracement in the silver to the exact penny again, and so it's holding up, pretty much where it actually should. Now, what I'm going to do is to show you the difference between the gold and silver, looking at them on a hourly chart, going back over a month, because it shows that the silver is actually holding up, much better than the gold. And that's the first time this has happened, in a long time. And we posted that chart about gold in about 20 minutes ago, right after the show started, that $15.70 per ounce, should be, good support. But failing that, you're looking at something, a lot more sinister. But right now, it's holding up, and that's the important thing, that the support has held, very, very well. And that's, at least for short term, that's what we're looking at now. we have one other commodity that I need to. Well, I should. Shucks. Let me switch and go to crude oil because we just covered that. Now we are breaking down below the 618 retracement in crude oil that came in at $90 a barrel, and we're now trading at half a dollar barrel under that, and we had a Gartley pattern up there at that 98 barrel level, and now we're 10% under that. And folks, let me. I don't know about the rest of the world, but in Tucson, Arizona, and in Scottsdale and Phoenix, Arizona, we've had $1 a barrel increase in the price of gasoline in the past 6 weeks. And the price of this stuff has been going down for 7 weeks. Now, there's got to be something wrong here. I know there's a delay between the time they take it out of the ground and when they bring it to us, but there can't be that much of a delay because when we have a price increase in the price of crude oil, the next day the price goes up in gasoline. So somebody's playing a different tune here in this crude oil market and also the gold the gasoline market. So I don't know why the futures are in such a discombobulation from what the real world is, but that's something that we have to live with. I don't understand why that would be a problem. Now I need to get to talk to us about the bonds because we have some important things I think occurring. One of the things that I think we forget about, this comes from Casey Research, is the fact that the variation in yields that we get in the junk bond market. Junk bond is a high yield market. They changed the name from junk bonds to high yield bonds when Milken came to work in the early 70s at Drexel Burnham. He wrote his thesis at Wharton because if you remember, interest rates were very high during that recession and companies could not get money. And so the only way they could do that would be to issue bonds, which were known as junk bonds. They historically they yielded some ridiculous amount like 25%, but at least the company would get the capital that they used. Well, Milken, through some smart marketing, said, look, we're going to call these things high-grade bonds, and Drexel Burnham became the bond king, and that's how it all started. We got a call from Vince in New Jersey. Vince, are you there?
I sure am, finally. How you doing, Larry?
I'm good, sir. What can I do for you today?
Well, this is the first time I get a chance to talk to you. I just got home from rehab. I had pneumonia, as I told you the last time. And my rehab class was always at 12 o'clock, so I could never listen to you or call you. Anyway, I just want to say hello and ask you how things are going.
Things are going good. I'm glad that you're finally out, Vince. You're a fine person. I know your wife takes good care of you, so you can't ask for more than that.
That's right. Thank God for that. I missed your opening statement, and I believe you were bearish. You're still. I'm sorry, I have a little brain fog.
That's okay. Well, I do too, Vince. And yes, I am still bearish, and mainly because of the pattern in the Dow Jones and the fact that the commodities are breaking down. We're breaking down in crude oil. The grain markets, wheat and corn, have broken down badly, and so some of these others are really starting to come apart. That's what the early part of the show was about.
Uh-huh. Yeah, I have my computer now, so as soon as I got home on Saturday, I went through all your shows, on the Tiger TV, but we never got a chance to talk. Just once I was able to call you. I snuck out of rehab, the gym, to just give you a call. But I want you to know I missed talking to you, and I missed your dissertations.
Well, that's okay. You can call me anytime, my friend. I always enjoy talking to you.
Thank you, Larry.
Okay, thanks for calling in, Vince. I really appreciate it.
Thank you.
And our prayers are with you, my friend.
Thank you.
Okay.
Anything else?
Okay. Bye-bye. Okay, we're talking about the junk bond yields and where they are now. Junk bond yields now are very close to where they're not far away from where the AAA or supposedly AAA U.S. government bonds are yielding, and that's that's another sign that I think that we have a potential problem of where a problem could actually come from, and that's one of the reasons why I'm so bearish to Treasury bonds. The last part of the the cycle that we're in over 30 years, I believe will come to pass to say that this is going to be a place where Mr. Bernanke is going to be in a spot where he really has a hard time getting it. Now, the main thing that I've always been saying about this for a long time is this big cycle that we're having is related to the debt cycle. We have debt all over the world. It doesn't make any difference, what country we're in or anything like that. They're all, very, very heavily in debt. And now people, because they're clamoring for yield, they're willing to buy this stuff. And this is the absolute worst thing that you could do. In 1981, you couldn't get people to buy debt, and that's when it was 12 and 14%. That was the absolute perfect time to do it. So we're in the same situation now. This is where you want to be, taking your mortgages and make sure you get a mortgage at 3.5% or under 4%, because you shouldn't lend anybody money at 4%, no matter what they are over a 30-year period, because there's just too many things that are there that make it really, really difficult to understand what's happening. Now, the next chart that I want to put into Tiger TV is a weekly chart of the 30-year Treasury bond, and it also overlaid on top of that is the 10-year notes. That'll be the white line. The candlestick line will be the Treasury bond line, and then the white line will be the Treasury notes. And Treasury notes have been stronger, and they've held up because they're still. We have these flights of quality where the market goes, and we still could have one more jab up. I'm assuming that we could get above the 150 level in the Treasury bonds one more time. Now, something happened this past Thursday that is very important in commodities if you trade Treasury bonds, and that is they switched from the March contract, they switched to the June contract, and that difference is over a point. It's a point and 1/8. In other words, 108 points, and that's a lot of difference. So in order for this, if this market does start to come down, since we're trading June bonds, you need the June bonds, which are now trading around the 144 level. You need to get those below the 141 level. That would be the first tip-off that, yes, we are getting ready, to see these higher rates coming. And we'll see if that, does transpire. But that's the main thing that we're watching in this bond market, is to see if we can get one more rally up. And, frankly, if stocks do sell off, we'll see. I don't know if you folks know this or not, but the stock market had been up every Friday for 11 straight Fridays. That had never happened in the stock market in its 200-year history. So that's another outlier event that was, I think, quite amazing. That was the Dow Jones. The report on the S&P and the NASDAQ was certainly not the same. And the other thing that occurred, we did not make new highs in the Russell Small Cap last week. The Russell Small Cap, did not make anywhere near, where the high was. Well, I'll use IWM because that's pretty much the ETF that everybody uses when they're watching this, and you'll be able to see that, it did not make a new high last week when we were making this, broadening top pattern. In fact, it's hardly rallied at all, recently because of the fact that I guess I don't know why the small caps would be so far behind, but I don't know, and I think it's down a little bit today. But as you can see, when we made that point D up there, we've made a different high in the Dow Jones, and the people report. If you notice that the financial markets that they talk about when you watch the newspaper, listen to the news, the very first thing they report is the Dow Jones Industrial Average, and that's not a good thing to report, folks, because it's only 30 stocks, and they're price weighted. You should do something like the S&P that are cap weighted, or ideally the New York Stock Exchange, which is cap weighted and has, well over 6,000 issues. So, and they're issues that, broaden the globe. So that's the really one, to take a look at. And I think that's the one that, is really the best one to look at if you're watching the market, as far as, being, if you want to see where it's really going. What I will do is I will bring up the NYSE index here, and let you see that I only have it on the. I have to go to make a quick change, but this is the hardest part when you're doing a radio show. You have to make a quick right turn in order to get a chart, and you don't have it in your portfolio right away. It makes it really difficult. But fortunately, I am getting a little bit better at this, and I'm able to. All I got to do is make sure it's refreshed, and you'll see that we've not made anywhere near a new high. We're still well over 3% away from that. We've completed all the patterns in this particular one. This is the daily of New York Stock Exchange Index, and if you look at the weekly, it's even more bearish because we went up to the 786 level and completed multiple ABCD patterns. There were 3 ABCD patterns that completed on the weekly chart this past particular time, going back several years. So whether this is going to turn the market down, we'll have to wait and see. But if you'll take just a few moments when you get a chance and look at this New York Stock Exchange Index on the weekly basis, and go back and look at the time. I'm going to circle it so that everybody can take a look at it in the Tiger TV, and you'll see when it made its high back in October of 2007. It made a marginal high, which was also nothing more than an AB equals CD pattern. I'll draw that in so that you folks can take a look at it, and that's when the big move started down. So just because things are into new high ground, does not necessarily mean that they are going to go, straight up. That's not necessarily going to be the case at all. So, don't be afraid here just because they're trying to tell you that you're going to miss a great move. There's so many things here, the divergences, the price of commodities, and particularly the price of copper, the divergence there, and the bullish and bearishness that we have is enough to scare anybody that's a technician. And of course, there's one other that that Basil reports about all the time that I think is extremely important, and that is the VIX index. And we'll put that up here right before we go to the break, and you'll see that we made a double bottom. We rallied up to the 61% retracement. And we filled the gap, the gap that was left from the old lows of 1929 that they talked about. And now we've had the pullback, stopped exactly at the around the 61% retracement, and the VIX is ready, to look to to go higher. And believe me, the VIX has no friends because there's still complacency, all across the markets out there. So it's very difficult to find anybody that is bearish. There are a few people, but as always, they're in the background. 877-927-6648.
If you're an investor looking for a great weekly investment newsletter, then now is the perfect time to try out Ken Shreve's Ultimate Growth Stocks. Every Tuesday, Ken breaks down multiple sectors in his weekly newsletter, Ultimate Growth Stocks, with a full in-depth report including specific trading recommendations within his model portfolio, charts, sector analysis, upcoming economic data, along with intra-week trading updates on newsletter positions whenever the market dictates. Right now, you can receive a full month, that's 30 days, to evaluate Ken's newsletter free of charge to see if it fits your trading plan. At less than $75 per month, Ken provides you with his expert trading advice that can pay for itself in no time. Take advantage of this great offer by signing up for a 30-day free trial to Ken Shreve's Ultimate Growth Stocks today. Don't let this offer pass you by. Visit the front page of TFNN.com and sign up now.
with the launch of Tiger TV. TFNN has brought our programming to the next level. With Tiger TV, you can gain access to each host's charts and computer screens as they host their daily stock program. Whether it's Tom O'Brien, Steve Rhodes, Basil Chapman, Ken Shreve, David White, Larry Pesavento, Victor Jones, or Daryl Martin, you can catch all of our technicians hosting their programs live and archived on Tiger TV for your viewing pleasure 24 hours a day, 7 days a week. If you haven't checked out Tiger TV, then visit TFNN.com and see what you're missing.
David White's newsletter, The Technology Insider, is focused like a laser on finding the next big things in technology. If you had invested only $10,000 in Microsoft in 1986, you'd have been a millionaire by 2000. Disruptive technology like Microsoft's is the key to these massive long-term profits, and the Tech Insider is the vehicle from TFNN to capitalize on these opportunities. This is the go-to newsletter that identifies, monitors, and profits on mostly little-known cutting-edge companies with great long-term prospects. David's experience is as an inventor of Emmy-winning animation products for TV and Hollywood that propelled a company public. Match that with 14 years as a full-time trader, and he's uniquely qualified to guide you through the light-speed world of ever-evolving high-tech. If you're ready to ride the next big technology bull market for less than $40 per month, log on to TFNN.com and get your 2-week free trial to the Technology Insider. Get in on the ground floor of the next big thing today.
Many of our new listeners have heard about the Tiger's Den, but wondered, what exactly is it? The Tiger's Den is a lively community where professional traders and investors can meet, exchange ideas and information in a comfortable, moderated atmosphere. Hear all of your favorite TFNN shows, plus see all the charts as they happen, live during those shows, and have access to all those charts. You can test drive the Tiger's Den, absolutely free, for 30 days. It will greatly enrich your knowledge of these markets. Details on the Tiger's Den are on the front page of TFNN.com.
Are you looking for a precision edge in the market? Something that can stack the odds in your favor? Then look into Larry Pesavento's new trading newsletter, Patterns, Profits, and Peace of Mind. In each weekly issue, Larry explains what's going to happen in the markets based on the pattern he sees developing and gives you actionable trade ideas based on those patterns. Plus, you'll get his detailed analysis on a variety of markets and sectors, including stocks, treasury bonds, the gold market, oil, the dollar, the forex market, and more. And you'll get the Technical Corner segment, which is a short but powerful weekly training session on trading. You'll get access to all the patterns Larry is seeing in the markets, plus the Astro Harmonics and powerful Bradley stock market model that Larry utilizes for less than $5 a day. An extremely potent combination that will give you just the edge you've been looking for. Try Patterns, Profits, and Peace of Mind absolutely free for 2 weeks. Go to TFNN.com and click on the free trial link at the top of the page. That's an $85 value, yours free when you register right now. Get Larry's Patterns, Profits, and Peace of Mind and get the edge you've been looking for.
This segment is brought to you by TFNN. Test drive all the newsletters for free at TFNN.com.
Okay, folks, we're at the 8th furlong of a 1-mile race, which means we're right at the finish line here. And I wanted to bring up a chart that affects us all, of course, and that's the U.S. dollar index. We are above the 61% retracement, above that 82 level that we've been watching for a while. But what is really important here, folks, is if you'll take a look at this chart, we have a situation where we have the potential for a head and shoulders pattern that is very symmetrical, very similar to what we have in the NASDAQ. If you look at the December high that we made in 2011 and go up to the high where we made the butterfly top in July of 2012, and here we are coming into the springtime of 2013, and we have made a very symmetrical, if it is a symmetrical, head and shoulders pattern, it's something that should be, observed by all of us, because it only has to go about another 60 points higher in the dollar index in order to complete the 786 retracement, and then that would be the spot that we take a look at. This is a very symmetrical chart. It follows the ratios extremely well, and it is also, it's weighted by the euro, which is 53% of the index. And so we really need to keep an eye on the euro. And the euro is making a 61% retracement right now from the big ABC that we made just a few weeks ago, and we are setting right on top of that as we speak. I mean, it's trading right there now at this 130 level, and so we need to pay attention to the euro versus the dollar index, because they're the same. The 53% weighted, so it's easier to trade the euro than it is to trade the dollar index. So we're very oversold in the euro. We're at major support coming down into this level right here. I think that we have a potential for head and shoulders in the dollar index. Down the road just a little bit, not too far from where we are. And there's one other thing that I think is relatively important, is there's a 70-day cycle that has been in the euro for quite some time, starting last July, and we had a perfect retracement in November, and then that's when we had that solar eclipse and new moon, and now we're over the same 70-day cycle low coming in right now, and it's approaching the 61% retracement at that 130 level. And it's very oversold. It's been down, since February, so it's down 5 weeks. And so we should get a bounce here in the euro. The pound looks like it's already started to, have a pretty good bounce. But the rest of them, we have to wait and see if they're going to be, looking at. But the pound, it has had a pretty good bounce already. And I'll put that one in, and you'll be able to see, because it came in at the 149.60 level, which was a perfect 1.27 expansion off of the triple top that we had over the past year, and that's the number that came in exactly on Friday. We're trading a little above, about a point above that right now. So these currencies could be getting ready to have a little bit of a rally. Whether it'll be much of a short covering rally or not, we'll have to wait and see. But this is what it looks like from cheap seats in Tucson, Arizona. Okay, I think that's about it. We're about ready to wind up the show. Live every day in an attitude of gratitude, and may God bless.
Let me tell you something, folks. I have people coming up to me saying, I just can't believe the amount of work that Steve does on his newsletter. And I says, I absolutely agree.
That is a recent clip from the Money Masters show that Tom and I do each day at TFNN. My newsletter service, Mastering Probability, is much, much more than a newsletter. Yes, it's outperformed the S&P 500 by 100% during the last 15 months. But more importantly, it's an extraordinary education, a roadmap for your success. And it's yours risk-free for the next 30 days. Just go to the homepage of TFNN.com and click on my name, Steve Rhodes, and then Mastering Probability, because everyone needs a success strategy. For most, it's a competitive edge, the will to win, the drive to overcome any obstacle. Whatever you call it, winners find a way. Find your way to Mastering Probability today, because your journey to extraordinary rewards is just one click away.